Hey everyone, welcome back to Corporate Dakota. Today DSGR just filed a Form 8K announcing a major deal, and I am seeing a big change coming for shareholders. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company is being bought out by an affiliate of its largest owner, and it means the stock will be going private. Alright, let's dive into this 8K filing from Distribution Solutions Group, Incorporated. The big news here is that the company has entered into an agreement to be acquired. This is what is called a going private transaction, meaning it will no longer be traded on the stock market. The deal was agreed upon on the 15th of July 2026. This deal is with entities formed by and connected to LKCM Headwater Investments, Incorporated. Now here is a key piece of context. Mr. J. Brian King, who is the company's Chief Executive Officer and Chairman of the Board, is also the Managing Partner of LKCM Headwater Investments. What is more, LKCM Headwater and its related parties already own a massive majority of the company's stock, almost 79%. So this isn't exactly a surprise takeover bid from an outside party. So here is how it works. A company called Eclipse Acquisitions Merger Sub Incorporated, which is a subsidiary of the buyers, will merge with Distribution Solutions Group. Distribution Solutions Group will continue to exist, but it will become a wholly owned subsidiary of the parent company. After this, Distribution Solutions Group will no longer be a publicly traded company, and its shares will be delisted from Nasdaq. Now, for the most important part for shareholders, the money, every share of Distribution Solutions Group common stock that is not already owned by the affiliates involved in the deal, or held by those who properly opt out for appraisal rights, will be converted into cash, and that cash amount is $35 per S-share. This is the merger consideration that shareholders will receive. Considering the current share price was floating around $34.43, this $35 per S-share offer seems like a fair premium for shareholders, especially given the recent news headlines where shares jumped after the agreement was announced and hit a 52-week high. The top institutional holder, King Luther Capital Management, which is heavily affiliated with the buyers, already holds a massive 78.7% of the company's stock. This means the vast majority of shares are already in the hands of parties who initiated this transaction. To make sure this deal was handled properly, the board of directors set up a special committee. This committee was made up entirely of directors who are not personally invested in the deal, meaning they are disinterested. Their job was to look at, evaluate, and negotiate the terms of this merger agreement. They had to make sure the deal was fair to the company and its shareholders who are not part of the affiliated group, and the special committee unanimously agreed that the merger agreement and the entire transaction were fair and in the best interest of the company and its independent shareholders. They then recommended to the full board that they approve the deal, put it to a shareholder vote, and that shareholders vote in favor of it. The board, after considering this recommendation and with some directors stepping aside from the vote due to potential conflicts, also approved the merger. Now, like most deals, there are conditions that need to be met before it is finalized. The main ones are getting the approval from the company shareholders. Specifically, a majority of all outstanding shares need to vote yes, and a majority of the votes cast by shareholders who are not part of the affiliated group need to approve it. This ensures that the disinterested shareholders have a significant say. Another key condition is the expiration or termination of the waiting period under the Hart-Scott-Rodino Antitrust Improvements Act, which is a standard review to make sure the deal does not reduce competition. There also needs to be no laws or court orders stopping the merger, and importantly, no material adverse effect that has happened to the company since the agreement was signed. The agreement also includes no shop provisions. This means Distribution Solutions Group can actively go out and look for other companies to buy them. However, there is a usual exception. If another company comes forward with an unsolicited offer that the special committee believes is a superior proposal, meaning it is even better than this deal, the company can, under certain strict conditions, talk to that third party and provide them with information. If such a superior proposal comes along, the board or the special committee, after consulting with legal and financial advisors, can change their recommendation to shareholders. They can even terminate this current merger agreement to accept the better offer, but there are rules in place for the buyer to get a chance to match any competing offer. There are also termination clauses for both sides. For instance, if the deal isn't completed by the 31st of December 2026, either party can walk away. Now, about those termination fees, if Distribution Solutions Group walks away from this deal to accept a superior proposal, or if the board makes a negative recommendation change about the deal and parent terminates it, the company would have to pay a termination fee of about $9.26 million. On the flip side, if the buyers fail to close the deal when they're supposed to, or if they materially breach the agreement due to a willful act, then Distribution Solutions Group would receive a reverse termination fee of around $22.23 million from the buyer. This is a pretty significant amount, showing the buyer has some skin in the game too. Let's talk about the money again, specifically how this deal is being financed. The company also entered into an amendment to its existing credit agreement with several lenders, including JP Morgan Chase Bank. This amendment allows the company to use proceeds from revolving loans to help finance this merger. On top of that, LKCM Headwater Investments IV LP, the same entity that is affiliated with the buyers, has also committed to investing another $125 million in equity through an equity commitment letter. This funding is crucial to making sure the whole transaction can be completed. To give the company more confidence, LKCM Headwater Investments IV LP has also provided a limited guarantee. This means they are backing certain obligations of the buyer, including the potential payment of that reverse termination fee we talked about earlier if something goes wrong on their end. There is also a voting and support agreement with LKCM, an affiliate of the buyer. In this agreement, LKCM commits to voting all the shares they own in favor of this merger. They also agree to vote against any other company trying to buy Distribution Solutions Group or any action that could hinder this deal. This further solidifies the support for the transaction from the largest shareholder group. For employees and directors holding stock options or restricted stock units, these will be handled in the merger. Vested restricted stock units, stock options, and performance rights will generally be cashed out at the merger consideration, similar to common stock. However, unvested restricted stock units will be converted into a right to receive cash based on the merger consideration, and they will continue to follow their original vesting schedules. This means employees won't immediately get cash for all their unvested equity. They will receive it as they continue to vest. Finally, this filing includes several exhibits that lay out the full details of these agreements: the merger agreement itself, the voting and support agreement, and the limited guarantee. There is also an amendment to the company's credit agreement. As is standard practice, the company notes that the merger agreement itself is provided to inform investors about the deal's terms, but it is not meant to provide general business information about the companies involved. The representations and warranties within these agreements are made for the parties during the negotiation and might not reflect the actual state of affairs for investors. The company also issued a press release on the 16th of July 2026 announcing this merger agreement. That press release is attached as an exhibit to this filing. For shareholders who want more details, the company plans to file a proxy statement and a Schedule 13E-3. With the SEC, these documents will give a lot more information about the merger. It is really important for investors to read these carefully once they become available, especially before making any voting decisions. Like most public companies, this filing includes forward-looking statements. These are statements about expectations for the future, such as when the merger might be completed or how the company will operate afterward. They're not guarantees, and actual results could be different due to various risks. The company warns that the merger might not be completed, or it might take longer than expected. There are risks related to getting regulatory approval, potential competing offers, and the general impact of the merger announcement on the company's business and relationships. My take on this filing is that it is a pretty straightforward private transaction. The biggest shareholder group, which is closely tied to the management team, is buying out the remaining public shareholders. The offer price of $35 per S-share seems to be a reasonable premium over the current trading price, and the deal seems well supported by the major stakeholders. The risk here for any remaining minority shareholders who are not affiliated with LKCM is that the market might not see much upside beyond the deal price unless a competing, higher offer emerges. For the company itself, this will mean a shift from being a public entity with reporting requirements to a private one, which can offer more flexibility but also less transparency for the general public. The biggest concern for anyone holding shares right now is simply ensuring they understand the process and timelines for their cash payout once the deal closes. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded if you found this analysis valuable. Please like this video and subscribe for more. You can also join our Discord community for more discussions linked in the description.